I recently attended a presentation for busy professionals about long-term care insurance, why you should care about it, the three main ways that it is offered or structured, and how much it costs approximately. Long-term care costs can significantly erode your nest egg in retirement, so it is very good to understand how this potential solution works. The presentation was over 30 minutes long, but today I'm going to lay out its key takeaways in about a third of that time, as I know you're all very busy and you want to get all the good stuff and then you want to go. So ready? Let's get into it. Why should you care about long-term care insurance? Medical costs are rising faster than the rate of general inflation. For example, we use a 3.75% average annual return as our long-term average yearly inflation rate for medical costs compared to the 2.25% long-term average yearly inflation rate that we use for regular costs. The average couple will spend $315,000 on healthcare expenses after age 65 per the Fidelity 2023 retirement healthcare cost estimate. Many people are shocked at how much it costs to provide long-term care for a family member. Let's look at a slide with the latest cost figures from the National Center for Assisted Living. Okay, so now you can see in the slide showing the types of care and the annual median cost. These are nationwide figures, so median means half of the costs are going to be above, half of the costs are going to be below. Home health care, homemaker services, $53,000 a year. Home health care with a home health aide, again, $54,000, $55,000, about the same. Assisted living community, roughly $51,600. Nursing home care in a semi-private room, $93,000 a year. Nursing home care in a private room, the median, it's $105,000 a year, and that's significantly more expensive in the major metropolitan areas like Los Angeles, Chicago, New York City, for example. Medicare, private health insurance, and Medicare supplemental insurance, also known as Medigap, do not cover the vast majority of long-term care costs. Why? Because health insurance covers costs for medical procedures and services, while long-term care insurance covers help needed to take care of the activities of daily living, ADLs for short. So what are the activities of daily living? They are, for example, eating, needing help with eating, needing help with bathing, or grooming yourself, dressing yourself, transferring from, let's say, bed to standing up, and toileting. So these are activities that we do every day to adequately function, but do not need highly trained medical professionals to administer. So long-term care insurance can be accessed to cover these costs when one is not able to do two or more of these activities of daily living. There are three main structures for long-term care insurance, ways that they're typically offered. Traditional long-term care insurance, hybrid policies, and life insurance with a rider. Traditional long-term care coverage is an agreement between you and the insurance company where you usually pay annual premiums for your lifetime for a certain level of benefits. You can add an inflation rider to a traditional policy so that the amount of benefits you are entitled to goes up by a certain percentage rate each year. Annual premiums can be increased by the insurance company on your class of policyholders if approved by the state, but not on you just as an individual. A con is that if you don't need long-term care service in this type of policy, you get no money back, just like home insurance or auto insurance. These policies will usually only reimburse the costs of qualified caregivers, not family members. The second type of insurance for long-term care is hybrid long-term care insurance policies. These, meanwhile, provide a small life insurance benefit should you not need long-term care services. Sometimes you can add an inflation rider to annually increase the value of these benefits that you have purchased. If you don't need to access the long-term care insurance benefits during your lifetime, then your heirs will get a small life insurance benefit, which some people really like. However, because of this life insurance benefit, hybrid policies are more expensive on a dollar-for-dollar basis for the same level of benefits compared to traditional long-term care insurance policies. In some cases, you can receive cash payment when you collect on the policy, so these cash payments can go to non-qualified, non-certified caregivers like family members. Also importantly, the annual premiums of these hybrid policies do not change. Lastly, the third version of long-term care insurance, life insurance with a rider, is truly a life insurance policy that simply allows you to accelerate accessing the death benefit should you need long-term care services in your lifetime. So if you have a, for example, $1 million death benefit on your life insurance policy, this type, then the death benefit will not change over time, and nor will your annual premiums. If you have long-term care expenses, though, during your lifetime, with this type of policy, you can access the life insurance policy's death benefit, and your death benefit will be reduced by the amount of cash you took out to pay for the long-term care expenses. Since you are just accessing the death benefit early, there is no inflation rider that can be purchased to increase long-term care insurance benefits, obviously. Lastly, the annual insurance premiums do not change. What I just went over regarding these three types of policies is summarized on a slide. Let's take a look at it now. So you can see in this slide showing now the three traditional types of policies for long-term care insurance: traditional, hybrid, and life insurance with a rider. And you see the green check marks are benefits that they have. You know, the blue with a little line through it is like sometimes this benefit is offered, sometimes it's not, depends on the specific policy, what the insurer decides to do. And the X's, of course, are where this is not an option available with this type of policy. So this is a very nice slide to be able to refer to when you need. To see roughly what regular long-term care insurance costs, let's go to a slide. Looking at this slide, you can see the costs of a traditional long-term care insurance policy. These are just general figures to give you a rough sense of what it costs. Of course, it varies from where you are in the United States, if you're in a big city or a small city, and also the amount of healthcare services that are available in that metropolitan area. But you can see that the costs in this example of a long-term care insurance policy for a $292,000 pool of benefits, that means a pool of benefits where you'd be able to access $73,000 a year for 4 years with a 3% inflation rider, is the following. You know, we have age 50, age 60, age 70. You see age 50 for a married couple, it's roughly $5,000 a year. At age 60, it's roughly $7,000 a year. At age 70, it's roughly $11,000 a year. So now that covers, you know, both people, of course. A male, if a male person just gets a policy for themselves, at age 50, roughly about $2,500, age 60, about $3,200, age 70, about $5,400. Females, you know, their policies are charged more because, you know, they tend to live longer, and the longer you live, the longer you tend to need to have the likelihood of having to access long-term care benefits. So for example, a female at age 50, her annual policy costs about $4,200 on average. The age 60 woman her policy costs $5,400, and for an age 70 woman, her individual long-term care insurance policy, this traditional type, is about $8,800. So you can really see what's going on. Here you can see that for the same age, the annual premium costs for women are far greater than those for men. You can also see that the longer you wait to get regular long-term care insurance, the more the annual premiums increase, as I mentioned just a little minute ago. Also remember that the longer you wait to purchase long-term care insurance, the greater the chance that you will develop a health condition which will increase the premium or make the insurer decide to deny you the coverage. Due to this, looking into long-term care insurance in your late 50s or early 60s can often be a good idea. I hope this video has been helpful. If you have any questions, please put them in the comments section below or reach out to my colleague Jesse Freeling. His contact information is also in the video's description below. If you would like to speak to an Altfest professional about your personal condition or situation with no obligation, please contact my colleague Jesse Freeling as well.